Hi, I'm Doug Jones at Buyers Realty, and this video is about contingencies. I represent buyers, and a contingency is basically an insurance policy for a buyer. And we have appraisal contingencies, property contingencies, and loan contingencies. So if a buyer makes an offer and it's got an appraisal contingency, then they're saying that property has to appraise for how much we're making the offer for. If not, we can choose not to buy it, or we can choose to renegotiate. But if the offer is made with no contingency, a non-contingency in the appraisal area, you can make non-contingencies in property, you can do it in appraisal, you can do it in loan, you can do it in all of them or none of them. But in my case, I've got one, we're doing a offer, and our offer does have a contingency. However, if it did not, here's the choices of things that could happen. My offer is for $745,000, and they're doing an 85% loan, which would be $633,000, means they put down $111,000. Now, suppose that property appraised for $730,000. The purchase price is still $745,000, so they got to come in with a difference with no contingency of another about $15,000. So what could the buyer do if they want to buy the property? Well, one, they could just come up with another $15,000, keep the same loan, or they could consider putting down $109,000, a little bit less, and increasing the loan amount. That'd be a 90% loan of $730,000. The lender is going to do their loan amount on the appraised value or the purchase price, whichever is less. So let's say that it appraised for $730,000 here, and they want to only put down less money. They could put down $88,000 and do a loan for $657,000. Now the thing is, they've got to qualify for these new loans. So there's a little bit of risk that maybe they won't qualify for the new loan. Sometimes loans are so close that that's the absolute limit. So if it's sold for $745,000 and there's no contingency, the buyer does not get the chance to cancel the transaction. They've got to pay, and if they want to cancel the transaction, then they've got to pay their earnest money deposit that they put down up front, which in this case is $22,000. So they could waive that and get out of the transaction completely. Or they can take the bank's appraisal of $730,000 and renegotiate the loan and maybe still try to save the deal. So you can get out of the deal, but you got to pay for it. Or you can try to renegotiate your loan amount. So there's some ways to do it, but it is at risk for the buyer with a no contingency. Now the real big loans are no contingency, or those with no contingency property, no contingency appraisal, no contingency loan. Those are risks. But in this market, sometimes we need to make that risk in order just to get in the contract. So I hope this helped explain the contingency, non-contingency. And the contingency is something that the buyer can just say no to if it appraises for less. The non-contingency, they can't say no. They got to make a decision, either coming up with extra money or getting additional loan size. So I hope that explains it. I'm Doug Jones at Buyers Realty.